I work with taxpayers that owe the IRS every Monday through Friday. And more often than not, when I show them things on previous year's tax returns, they say to me, well, I didn't know that was on my tax return. Did you know in order for your tax return to be filed, it has to be signed? And when you sign it, you are stating that under penalties of perjury, I declare that I have examined this return. So that means you looked at it and the accompanying schedules and statements. And to the best of my knowledge and belief, they are true, correct, and complete. Did you know that you signed that? So as far as the IRS is concerned, you've looked at this, you understand it, and you believe it all to be true. But here's the thing. Did you look at it? Did you understand it? If you're married filing joint, did you just let your spouse take care of everything? See, I believe that all taxpayers have the right to understand the tax return that they sign. So in today's video, I'm going to go over the 2021 draft of the 1040. Now, on today's date, this is the most recent draft as that came out on July 21st of 2021. So this is what we will be filing in spring of 2022. It is likely some things may change, but for the most part, the 1040 stays the same as far as the order in which things flow. So I'll show that to you here today. For those of you that don't know me, my name is Timalyn Bowens, and I am America's favorite EA. I'm also the owner of Bowens Tax Solutions, which is a virtual firm based in Louisville, Kentucky, and we specialize in resolving taxpayers' issues. So let's get right to this 1040, okay? It's very important that you understand where certain things go so that you can point it out to your preparer, like, hey, I don't necessarily understand this. Can you help me out? You'll also be able to see if your preparer is omitting certain things or if they just in general did a miscalculation. All tax preparers are human, so it happens sometimes, but you don't know if you don't know what to look for. So right here at the top, each individual taxpayer files a Form 1040, which is the U.S. individual income tax return. And like I said, this is for 2021. Now, typically for me, I go over this with clients before it's filed, and it's crazy to me when I get new clients and they tell me nobody has ever done this before and I don't understand where things are on the tax return, because I'm like, what in the world? You've been signing this and you've been on the hook with the IRS for years and never understood what you're signing. So first off, we have your filing status. The filing statuses that we have are single, married filing jointly, married filing separately, head of household, qualifying widow or widower. Single, pretty straightforward, means you're not married. If you are married and you lived with your spouse the last 6 months of the year, you cannot use the single designation. Married filing jointly is for individuals that were married on the last day of the year. So even if you got married on December 31st, that is still going to count as far as the IRS is concerned. Married filing separately, maybe your spouse has a tax debt or their refunds get garnished due to back child support or other types of bills. If that's the situation, you may file as married filing separately, which I typically advise my clients to do if their spouse has some type of garnishment that takes their refunds. Head of household. This is for people who have dependents in their household that they take care of. It may be a qualifying child or relative, or if you take care of a parent that lives on their own, but you take care of more than half of their living expenses. Head of household cannot be used if you are married and living in the same house as your spouse. Now, There are exceptions to the rule. If you were married and separated the last 6 months of the year, but you still have children in your home, then you may qualify for head of household. Next, we have the qualifying widower. A qualifying widower is someone who has dependent children and their spouse has died within the past 2 years. This status is pretty similar to married filing jointly. Just so I don't misspeak, I'm not going to say it's the exact same, but it definitely has better benefits than head of household. Okay, so the first thing you want to do, make sure your status is correct, because you don't want to get a letter a couple of months later saying, hey, you didn't use the right filing status. Next is pretty straightforward. You're going to have your name, middle initial, last name, social. Guys, you want to check the smallest details. Right here with your social security number, you want to make sure that's correct. You don't want to get a letter from the IRS saying, hey, you omitted some income or didn't file a return because the social security number is not correct. Now, typically, if you're e-filing, it will reject it if the social security is not correct, but you never know. And we've had 2 back-to-back funky seasons, so definitely want to check that before your preparer sends it through. If you have a spouse, same information for them, first name, middle name, last name, social. Here, you want to use your current mailing address. I've had people say, oh, well, I used the address that I lived in during that year. If you don't live there currently, if the IRS has any type of correspondence to send to you, you won't get it because it'll go to that old address. You definitely want to make sure you use your current address. So if we have more stimulus checks come out, advanced child credit checks come out, excuse me, getting tongue tied, it'll get to you at the right address. Okay. So always use the address that you live at now or your permanent address. City, state, zip code. If you are here in the States, you don't have to worry about the foreign country name, province, code. Here to the right, we have the presidential election campaign. If you don't want $3 to come out of your refund, then you're not going to check that box, okay? At any time during 2021, did you receive, sell, exchange, or otherwise dispose of any financial interest in any virtual currency? So keep in mind, if you're buying things like Bitcoin, Dogecoin, those types of things, the IRS is wanting to know that now because you are going to be taxed on those capital gains from making sales. So if you've sold that, you want to check this box, yes. If you know you've sold that and your preparer didn't ask you, so it's not checked, you need to let them know yes, because if you sign this return saying everything is true and it's checked no, that means you've just lied to the government now. All right. And we don't want to do that because we don't need any unnecessary tax problems. So here you want to mark if somebody can claim you as a dependent or your spouse as a dependent, because that will change the amount of your standard deduction. If you're filing separately from a spouse and they itemize, then you too have to itemize. So you want to make sure you check this box. If you were born before January 2nd, 1957, or you're blind, or those things apply to your spouse, you want to check here. And the reason you want to check here is because you get a little bit more on the standard deduction. So you have a slight tax benefit there. Here, this section, we're going to list any dependents. You want to make sure that your dependents' names are spelled correctly. Make sure that you have the correct social security number, the relationship to you. If they qualify for the child tax credit, you want to make sure you check that here. If they are older than the age to qualify for the child tax credit, then you want to make sure you have this box here checked for other dependents. For 2021, we have for children 5 and under, the child tax credit will be $3,000. For children that qualify 6 and up, it will be, I'm sorry, I said it backwards. For children 5 and under, it's going to be $3,600. For children 6 and up that qualify is going to be $3,000. The credit for other dependents, so maybe your child is in college, or if you have a parent that you're taking care of, is going to be $500. And we'll talk more about credits down below. So lines 1 through 8 is going to be all of your income. Now, you may be thinking, well, all of my income is not taxable, so I'm not going to give that to my preparer. And you want to make sure you give all of your income to your preparer, because the majority of this is going to be reported even if it's not taxed. So line 1 is going to be where the total of your W-2s go right here. So box 1 from your W-2 should check out with box 1 of the tax return. And like I said, if you have multiple W-2s, then you'll want to add up your box 1s and make sure that it checks out with this. 2, we have taxable interest here. And then you see here, anything taxable is going to be over here. Tax exempt interest here. We're going to have qualified dividends here. Ordinary dividends. We have IRA distributions. So some of that may be taxable. So the whole amount will go here. Taxable amount here. We're going to have pensions and annuities. Again, whole amount here. Taxable amount here. Same thing with social security benefits. And I'm going to do a video later to specifically talk about social security benefits, because no, social security benefits are not taxed unless you go over, and there's a whole thing that we do with provisional income that could make up to 80% of that taxable. So for some of my taxpayers out there, if you have social security benefits, as well as these other income resources, not resources. If you have social security benefits as well as other sources of income, part of your social security very well may be taxed. Line 7, we have capital gains or losses. So capital gains or losses are going to be when you sell any stock, if you sell property. So if you have a home, if you have a car that you sold, you are going to put your capital gain or loss right here. Other income is going to be things like if you have income from a business, if we have unemployment income, prize income, hobby income, that will all come through on line 8 from your Schedule 1, which Schedule 1 is adjustments to income. So the additions that I just mentioned, and also is going to be things that you subtract as well. For example, student loan interest. If you're self-employed and have insurance, it's going to be the self-employed health insurance deduction. Those are adjustments, okay? So line 9, we're going to add all of your income. All right, so again, if you know you made about $50,000, line 9 should have about $50,000. So if you're looking at a tax return that your preparer did, you know you made about $50,000, but line 9 is saying 75,000 or it's saying 35,000. You want to say, hey, raise your hand. I don't understand what this difference is, and make sure you have the right thing, because remember, you're signing this, and at the end of the day, you're going to be held responsible. So line 10 is going to be adjustments to income from Schedule 1. So like I mentioned, the things that bring your income down. So like that student loan interest, self-employed health care deduction, those types of things are going to be added up and put on line 10. Line 11 is your adjusted gross income, AKA AGI. This is going to be a number that's important that you know how to locate, because if you're applying for a mortgage, they're going to want to know your AGI. If you are applying to have an income-based repayment plan for student loans, or I think it's also income-driven repayment plan, you need to know your AGI as well. So line 12, we have the standard deduction or the itemized deduction. The standard deduction is going to be a set amount that the IRS has each year. So we see here to the left, if you're single or married filing separately, it's going to be $12,550. Married filing jointly, we have $25,100. Head of household, we have $18,800. But if you itemize, that means you have things like mortgage interest, you have property taxes paid, You can itemize your state and local taxes. If those amounts go above what your standard deduction is, I highly recommend that you itemize versus doing the standard deduction. Now, keep in mind, if you do have a pay prepare, itemizing is going to typically cost you more than the standard deduction just because there's more work now for the preparer to do. Charitable contributions, it was new on the 2020 form that you could take up to $300 of your charitable contributions, cash donations, $300 if you were filing as married, filing jointly, or single, or head of household. If you were doing married filing separately, it was $150. That was for 2020. I'm not 100% sure what it's going to be for 2021, so I'm not going to say a number. But right here, even if you don't itemize, now the IRS is allowing you to write off part of your cash contributions, okay? But you want to make sure you have your statement from whatever the organization was that shows that you did make a cash donation and you didn't receive anything tangible as a benefit from doing so. So once we add up the two deductions, standard or itemized, and the charitable contributions deduction, we're going to add that together. Line 13, we have the qualified business income deduction. So that's for business owners, something I can make a whole other video about, so I'm not going to get into deep here. We're going to add all of those deductions, subtract them from line 9 to find your taxable income. So, okay, everything you made on your W-2, you're not going to be taxed on that whole amount because we have these deductions that we just went over up here. So your taxable income, oops, sorry about that. Your taxable income is going to be different from your gross income. So your gross income was just all of your income before it gets taxed. Taxable income is what we're actually going to look at the tax brackets and see how much you owe the IRS for this year. So there are tables that you can look at or percentages you can use. The tax amount is going to go right here. Then we have other taxes that we're going to look at from Schedule 2. Once we do that, we're going to add lines 16 to 17 to get the total tax. Then we're going to start applying our non-refundable child tax credits. So the child tax credit, credit for other dependents, then we look at other non-refundable credits. So on page 1, we had tax deductions, which reduced the amount that we were taxed on. Tax credits are different because a tax credit is going to allow us dollar for dollar to knock out this tax. So say, for example, that you owe the IRS $15,000, okay? So you have 2 children that are over the age of 5. So you have $6,000 worth of a non-refundable credit. Let's say you don't have any other credits, just for the sake of this example, right? So dollar for dollar, $6,000 is going to go away, and now your tax liability is $9,000. Make sense? All right, so let's get rid of that. So we have non-refundable credits like those there. And remember, if the child is older or a parent, it's going to only be $500. The amount from Schedule 3 has other credits. So if you made any estimated tax payments, that type of thing, that's going to be treated as a credit, and dollar for dollar knock out that liability. So once we add that down here, we're going to subtract line 21 from 18 because, again, dollar for dollar is knocking it out. Then we have other taxes, including self-employment tax. So if you're self-employed and you've been making money, you're no stranger to self-employment tax. It's a self-employed person's share of Social Security and Medicare. We add that after any credits have been applied because you have to pay your self-employment tax. Reason being, We are in desperate need of the Social Security, Medicare benefits accounts being funded. So the IRS makes sure that you pay those no matter what. So after we add that, we have your total tax. Then we look and see what payments that you've been making. Okay. So I did misspeak earlier, charge my head, not my heart. Estimated tax payments do not come through on line 20. Those are simply just the other credits. So we look if you had a W-2 job to see how much you had withheld from your W-2 job. If you had a retirement distribution, we look at the 1099-R to see how much tax you had withheld. Or if you had 1099 from unemployment, or if for whatever reason on your independent contractor job, they had to withhold, all of that withholding is going to be on 25B. Then if you had any other forms where you had tax withholding, that's going to go here. We're going to add up everything you had withheld. Then we're going to factor in your estimated tax payments, which you should be making if you believe you'll have a tax liability of over $1,000 and you are self-employed or you're planning on having capital gains from a sale. And that includes stock sales as well. If you qualify for the earned income credit, we're going to factor that in right there. Then we have non-taxable combat pay election. So if you were active duty in a combat zone, then we're going to have the prior year earned credit, earned income. This is used because there was a special exception made after 2020 with the pandemic, so that certain individuals may still qualify for the earned income credit if they earned more in the prior year. We'll see whether or not that's going to stay for this year when the final form is released. We have the refundable child tax credit or additional child tax credit. So what this is here, as I mentioned before, up above, that was non-refundable. If your entire tax liability is wiped out before using the full credit, then the rest of it, based on income and threshold, the rest of it will become refundable. So that goes here. American Opportunity Credit is for taxpayers who have a child or they themselves are in their first 4 years of college and have eligible expenses. Recovery rebate credit was new last year. This is if the IRS messed up and did not send you your stimulus checks, or if they simply couldn't find you because you didn't have the correct address or bank account didn't work. You can claim that stimulus check here, line 30. Once we add up all these credits, we're going to put them here. And again, subtract, or no, I'm sorry. We're going to add that to the other payments that have been made. Then we are going to see if your payments are more than the actual tax liability. If they are, right here, line 34, we're going to see the amount that you overpaid. This is the amount that you want refunded to you. If you're a business owner, I would recommend using part of this to apply to your 2022 estimated tax. If you're not and you don't plan on having any type of additional income like stock sales or capital gains, then definitely let the IRS refund you, give you all of your money back, because nobody's into giving them interest-free loans, right? Make sure if you want direct deposit that you double check your routing number and your account number here. Now, on the flip side, let's say that the payments that you made are less than the tax liability. Then you're going to have an amount that you owe. Now, if you can't pay the whole amount that you owe, don't worry about it. You still need to file your tax return ASAP. And here's the reason why. If you file it past the due date, you're going to accrue more penalties, called a failure to file penalty. In addition to that, if it's not paid by the due date, you're going to accrue failure to pay penalties. We don't need these unnecessary penalties. So get the return filed as soon as you can. And then if you can't pay in full, there are opportunities to set up payment plans with the IRS. The IRS will work with you so you can pay this debt off, but the worst thing you want to do is procrastinate and put it off so they have to come find you. So then we have Form 2210, which again is not here, but we use that form to figure any estimated tax penalty. If you have a paid preparer, typically they'll be the third-party designee. So you have their name here, phone, their personal identification number. This is for if you don't want to speak with the IRS about your tax return, or you have a family member even that you feel is better versed to talk about it, then you would put them as the third-party designee, and this just gives them permission to talk about the return on your behalf. So here we have the signature part. You're going to sign, date, occupation, put in your identity protection PIN. This is if your identity has ever been stolen, or if you just have concerns about your stuff being sent electronically. Each year, the IRS will send you a new identification protection PIN, and that number will have to be entered before it can be e-filed. And note, here's the part I stated before, when you sign this, you are saying, under penalties of perjury, I declare that I have examined this return and accompanying schedules and statements, and to the best of my knowledge and belief, they are true, correct, and complete. Declaration of preparer, other than taxpayer, is based on all information of which preparer has knowledge. So that means if you have a paid preparer, it's just saying that they relied on everything that you gave them, nothing else. So again, this is going to be on you that all of this information is true. Now, last but not least, this is where I see a lot of people get in trouble just because you don't know. That's why I want to tell you today and show you. If you are paying somebody to do your return, this here should not say self-prepared. Again, if you are giving somebody dollars to prepare your tax return, this should not say self-prepared. All tax professionals that are authorized to prepare returns in exchange for monetary benefits. So they charge you, if they charge you $10, if they charge you $1,500, they are required to have what is called a P10. This stands for, oh my goodness, now I'm running a blank. It's Prepared Tax Identification Number. There we go. We have to have this. If the P10 information is not filled out and it says self-prepared, you need to run. You want to make sure that your preparer has a prepared tax identification number. Otherwise, they are trying to prepare under the IRS radar. In addition to that, if they want you to paper file and this has not been rejected, you also need to run. Unless this return is 3 years old, they can still e-file it under their software, and the IRS wants them to e-file it if they've prepared more than 10 returns this year. So you want to make sure they have the P10. It will start with the letter P, and then they'll have numbers after that. You want to make sure that their business name is here, address, as well as their EIN. Their EIN is going to be their entity identification number, which is similar to your social security number. So it just identifies them with the IRS. That, though, is not going to be the most important part. Make sure before this goes in, it does not say self-prepared and they have a P10 in here. Otherwise, they should not be getting paid for preparing your return. So I hope this video has been helpful for you. I hope that you understand a little bit better what you're signing when it comes to tax time. If you have any other questions about this, be sure to drop them down below in the comments for me. If you found this beneficial and you think that family and friends could also benefit from knowing what the different lines of the tax return are, make sure you share it with them. And last but not least, because I do specialize in resolving IRS problems for taxpayers, if you have a balance that you can't pay in full, you can book a no obligation call with me at www.bowenstaxsolutions.com under the book now button. If you have the debt you can't pay in full, or if you have an IRS notice that you don't understand, you can book a call with me and we'll see if we're a good fit to work with each other. Until next time, stay out of tax trouble.